Yesterday, a wallet that hadn't moved a single Satoshi in 12 and a half years sent 500 Bitcoin to a completely new address. No announcement, no statement, no explanation. The coins were acquired in November of 2013 when one Bitcoin cost less than $1,000. The person who bought them sat perfectly still through every crash, every panic, every cycle that followed. They watched Bitcoin lose 80% 4 separate times. They watched governments try to ban it, institutions mock it, and retail investors capitulate in waves. They didn't move. They didn't sell. They didn't do anything until yesterday. And the detail that has the on-chain analytics community unusually quiet this morning isn't the size of the move, though $40 million is not trivial. It's where the coins went, not to Coinbase, not to Binance, not to any exchange wallet that blockchain trackers can identify, to a fresh native SegWit address created one day earlier, a brand new wallet that didn't exist 48 hours ago. And that single detail is precisely why traders who understand what they're looking at are very carefully not making assumptions. Because this whale had options. They chose one that tells you almost nothing on purpose. Quick note before we go further. Nothing here is financial advice. I'm not your broker. I'm not your advisor. I'm connecting signals. What you do with them is entirely your decision. Now let's talk about what yesterday's transaction actually reveals. The wallet is identified by on-chain analytics as address 1KAA8G, created November 27th, 2013, 500 Bitcoin received when the price was roughly $923. Total acquisition cost, $461,000. Those coins have been sitting untouched since then. Through Bitcoin's collapse from over $1,000 in December 2013 to under $200 in 2015. Through the 2017 bull run that the entire world watched. Through the crash of 2018, through the March 2020 panic when Bitcoin dropped 50% in 48 hours, through the all-time highs above $108,000 in 2025, untouched. That is not carelessness. That is not forgetting. An address that receives coins in 2013 and holds through every major cycle is the on-chain equivalent of absolute conviction. This is someone who understood something back then that the rest of the world is still catching up to. And now, on May 10th, 2026, with Bitcoin trading between $80,500 and $82,458 on Bitstamp, they moved the entire position for the first time. The transaction fee was 0.0001 Bitcoin, $8. That is the fee someone pays when they are in no hurry whatsoever, when they are not racing to hit a bid on a centralized exchange before prices shift, when they are not dumping into a liquid market in real time. Kai-Young Ju, founder of CryptoQuant, said it plainly on May 10th. Classic OTC prep, not dump pressure. Low fees and non-CEX destination scream institutional. And that single interpretation, OTC, not exchange dump, changes everything about what this transaction means. Most people who saw the headline thought the same thing. An old whale woke up. They're probably selling. Prepare for selling pressure. That's the conditioned reflex. Ancient coins move. Price falls. It's happened before. It's not an unreasonable assumption. But reflexes are built on pattern recognition from previous cycles. And what Look & Chain's tracking data shows for 2026 specifically is that the pattern has shifted. 72% of 2026 whale moves involving Bitcoin dormant for more than 7 years resolved as over-the-counter transactions within 48 hours. Not exchange sells, OTC. That means the buyer exists before the coins even move. That means institutional capital, the kind that moves through private desks rather than public order books, is absorbing the supply before it ever touches a retail exchange. The market never sees the sell pressure because the transaction happens off-book between a seller and a prearranged buyer, typically at a slight premium to spot. This is not a panicked early adopter liquidating after 12 years. This is a transaction structure. A professional exit, or repositioning, that leaves no visible footprint in the order book. The public sees a scary headline about a dormant whale waking up. Institutions see a counterparty. Now here's where this specific move starts to connect to something much larger. This wallet did not wake up in isolation. On the same day, May 10th, between blocks 948,694 and 948,822, a cluster of wallets created between 2013 and 2017 collectively transferred 859.13 Bitcoin. $69 million in previously frozen, long-dormant coins moving on the same day. 6 transactions from wallets opened in 2017, 4 separate 10 Bitcoin transfers from 2014 wallets, and the anchor event, the 500 Bitcoin from November 2013. That's not one whale. That's a trend. And when you zoom out from yesterday and look at what's been happening with dormant wallet activity across the past 12 months, the picture becomes significantly harder to dismiss as coincidence. Go back to July of 2025. 8 Satoshi-era wallets, each holding 10,000 Bitcoin each, inactive for more than 14 years, moved their coins within a narrow window of time. 8 of them. In total, 80,000 Bitcoin moved. Approximately $8.6 billion at July 2025 prices, when Bitcoin was trading around $108,000. Those 80,000 coins were originally acquired in 2011 for a combined total of less than $210,000. The percentage return on those positions was approximately 4 million percent. 4 million percent. And somebody decided July of 2025 was the moment to finally act. Not 2021 when Bitcoin first hit 68,000. Not 2024 when Bitcoin crossed 100,000. July 2025. Then in September 2025, a separate wallet, dormant since 2013, moved 1,000 Bitcoin worth about $116 million, timed just ahead of a Federal Reserve rate decision. In January 2026, a 2013 wallet transferred 909 Bitcoin, worth roughly $84 to $85 million. Also in January, a 2010-era miner wallet moved 2,000 Bitcoin, nearly $200 million, directly to Coinbase. That one was unambiguous. That one was an exchange send. That one was a sell or a custody migration to a regulated custodian. In March 2026, a wallet dormant since 2012 moved 2,100 Bitcoin worth approximately $147 million. The original cost of that entire position, $13,685. And now, yesterday, the 500 Bitcoin at $40 million. This is not random. Something is causing a generation of early Bitcoin holders, people who survived more than a decade of silence, to simultaneously begin making decisions. The question is what? There are 3 possible explanations, and the correct answer probably isn't the one most analysts are leading with. The first explanation is the simple one: profit taking. Bitcoin is at $81,000. These people bought it under 1,000. The gains are so large that even a small fraction sold creates life-changing liquidity. At some point, it becomes rational to act. That's true. It's also incomplete, because if pure profit-taking were the primary driver, you'd expect the coins to flow directly to exchanges. Centralized exchanges are where you convert Bitcoin to dollars. The fact that 72% of these moves resolve as OTC, as prearranged institutional trades, means the seller has a buyer in mind before they move a single coin. That's not opportunistic profit-taking. That's a negotiated transaction. The second explanation is security migration. The Bitcoin ecosystem has changed dramatically since 2013. Wallet formats, custody standards, address types, hardware options, all of it has evolved. A native SegWit address, which is where yesterday's 500 Bitcoin landed, is more efficient and more modern than the legacy address it came from. Some long dormant holders may simply be upgrading their custody architecture. That's plausible, but it doesn't explain the clustering. 7 different dormant wallets activating on the same day, without any obvious technical forcing function, doesn't suggest independent security upgrades happening to coincide on May 10th. The third explanation is the one that should genuinely make you sit with it. These holders are repositioning for a different kind of world. Here's a data point that doesn't get discussed enough in dormant wallet conversations. Bitcoin's revived supply, meaning coins spent by wallets that had been dormant for at least a year, hit approximately $2.9 billion per day in October of 2025, the second highest level ever recorded. And the average age of those spent coins was rising simultaneously. In early 2023, the average age of spent Bitcoin was 26 days. By October 2025, it had risen to approximately 100 days. That's a metric that describes a fundamental shift in who is selling Bitcoin and from how long they've been holding. As that average age rises, the coins entering circulation are increasingly ancient. They were acquired in a completely different era of Bitcoin, under completely different assumptions about what Bitcoin was and what it could become. And here's the implication that almost nobody is connecting directly. When ancient coins begin moving at scale, it doesn't mean early believers are abandoning Bitcoin. In many cases, it means Bitcoin has become valuable enough, legitimate enough, that the exit mechanisms have finally caught up to the asset itself. Because for years, the problem for a holder of 500 Bitcoin wasn't conviction. It was liquidity infrastructure. How do you exit a $40 million position without destroying the market yourself? In 2017, you couldn't do it quietly. The OTC infrastructure for that size was underdeveloped. You either dripped coins slowly onto exchanges, used a relatively thin OTC desk, or held. By 2026, the infrastructure has changed completely. BlackRock's IBIT has $75 billion in assets under management. Fidelity's FBTC has over $20 billion. Total US spot. Bitcoin ETF inflows have exceeded $53 billion. Daily inflows running over $500 million. There are institutional buyers who can absorb $40 million in Bitcoin without blinking. The liquidity to exit, quietly, professionally, at institutional size, finally exists. And when the exit infrastructure matures, positions that were technically liquid but practically impossible to move begin to move. But let's hold on before we accept the exit narrative too quickly, because the destination of yesterday's coins raises a question that should give you pause. The 500 Bitcoin went to a fresh native SegWit address created the day before, not to an OTC Desk's known receiving wallet, not to a Coinbase custody address, not to a Wintermute or Galaxy digital wallet that Look and Chain's tagging system would recognize, to a brand new, completely untagged address. CryptoQuant called it OTC Prep based on the fee structure and the non-exchange destination. That interpretation might be right. But OTC Prep and custody upgrade aren't the only things that result in coins moving to a clean, untagged, freshly generated native SegWit address. Institutional accumulation by an entity that doesn't want to be identified uses the same structure. A strategic Bitcoin reserve acquisition, hypothetically, through a private intermediary, would look exactly like this on-chain. A pension fund accessing Bitcoin through a regulated custodian rather than directly, same structure. A family office building a position for a trust structure, same structure. The blockchain shows you movement. It does not show you intent. And right now, the intent behind yesterday's $40 million transfer is genuinely unknown. That uncertainty is not a gap in the story. It is the story. Because here's what the timing reveals, and this is the part that should reframe everything. The 500 Bitcoin moved on May 10th. The Senate Banking Committee is scheduled to vote on the Digital Asset Market Clarity Act on May 14th, 3 days from now. The Clarity Act is the most consequential crypto market structure legislation in American history. It resolves the jurisdictional ambiguity that has kept trillions of dollars in institutional capital, pension funds, endowments, wealth management platforms, sitting at the edge of the Bitcoin market without committing. The moment that bill exits committee and moves toward a Senate floor vote, the legal argument for institutional abstention begins to collapse. The compliance clearance process starts at the largest capital allocators in the world. The inflow timeline compresses. And the White House advisor for digital assets, Patrick Witt, told the Bitcoin 2026 conference in Las Vegas last week that a major operational announcement on the strategic Bitcoin reserve is coming within weeks. The U.S. government currently holds 328,000 Bitcoin, the largest known sovereign Bitcoin position in the world, within weeks. The holder of yesterday's $40 million in Bitcoin knew all of this when they decided May 10th was the day to finally act. Maybe they're selling into institutional buyers who are front-running the legislative clarity event. Maybe they're restructuring for inheritance purposes as Bitcoin's legal status becomes formalized. Maybe they're routing into an entity that will benefit from the reserve announcement. Or maybe they're simply doing what any sophisticated long-term holder does when the price has risen 88-fold and the legal infrastructure to monetize professionally has finally arrived. The one thing that's certain is this: someone who held through 12 and a half years of silence didn't choose May 10th arbitrarily. Now, let's talk about the broader pattern, because what yesterday's transaction represents at the micro level mirrors exactly what is happening at the macro level. And once you see the parallel, you can't unsee it. At the individual level, a holder who acquired Bitcoin in 2013 sat through every cycle, watched every false alarm and genuine crash, and waited until the structural conditions, price, liquidity infrastructure, regulatory clarity, aligned, then moved. At the institutional level, pension funds, endowments, wealth managers who watched Bitcoin for years, ran the risk assessments, waited for ETF vehicles and legal frameworks, and are now moving into the asset as the regulatory picture firms up. At the sovereign level, the United States government, which for years treated Bitcoin as a criminal asset to be seized and liquidated, now holding over 328,000 coins as a strategic reserve and preparing an operational announcement. Different actors, different scales, identical underlying logic. Wait until the conditions are right, then move with conviction. The ancient wallet that woke up yesterday isn't anomalous, it's a microcosm. Here is what the on-chain data actually tells us about the supply situation, stripped of narrative. After the April 2024 halving, new Bitcoin supply is fixed at 3.125 coins per block. At 10-minute intervals, that's approximately 164,000 new Bitcoin per year. That number cannot be changed by any government, institution, or legislative act. Simultaneously, an estimated 4 million Bitcoin are permanently lost. Inaccessible wallets, forgotten private keys, coins sent to unspendable addresses. That supply is also permanently offline. More than 95% of Bitcoin's total supply was mined by March 2026. The remaining supply enters circulation at a rate that shrinks with each halving. Meanwhile, BlackRock's IBIT and Fidelity's FBTC alone, two products that didn't exist 24 months ago, are absorbing institutional capital at a pace that Bitwise projects will exceed 100% of new annual supply. That means ETFs alone would need to acquire Bitcoin from existing holders to satisfy demand, because new mining supply cannot cover total inflow volume. Now add the OTC transactions, like yesterday's. Where are those coins going? To institutional buyers, likely long-term holders, who are removing them from the circulating supply just as efficiently as the ETFs. And here's what that means for the float. Bitcoin's total supply is 21 million. Subtract permanently lost coins, subtract long-term holder supply that hasn't moved in years, subtract ETF custody holdings, subtract the growing sovereign reserve, subtract the OTC absorbed ancient coins. The actual liquid Bitcoin, the coins that could change hands on a public exchange on any given day, is a fraction of what the headline supply figure suggests. And that fraction is getting smaller, not because of speculation, because of structural absorption. The demand side is broadening. The supply side is tightening. The regulatory framework that would accelerate both is 3 days from a committee vote. This is the context inside which yesterday's $40 million transaction occurred. Let's talk about something that doesn't get enough attention: the psychological weight these dormant wallets carry in the market. It's disproportionate to their actual supply. The 500 Bitcoin that moved yesterday represents a tiny fraction of total daily Bitcoin trading volume. In a market processing billions of dollars in transactions, 500 Bitcoin is a rounding error, and yet Whale Alert flagged it. Look and Chain analyzed it, CryptoQuant commented on it. It made headlines across a dozen major crypto publications within hours. You're watching a video about it right now. Why? Because these wallets are not just coins, they are proof. They are living evidence that someone who acquired Bitcoin when it was worth less than $1,000, when almost nobody believed in it, chose to hold through the ridicule, the crashes, the regulatory uncertainty, the exchange hacks, the media obituaries, the congressional hearings, the bankruptcy cycles, all of it. And now they are doing something with those coins inside an infrastructure that didn't exist when they acquired them, inside a world that has fundamentally changed. The market's fixation on these wallets is partly fear, partly fascination. But mostly it's this: early holders are the market's oracle class, not because they can predict the future, but because they watch the evolution of this system from its earliest days. They understand what Bitcoin actually is, at a level that people who arrived in 2020 or 2021 or 2024 simply don't yet have. When they act, the market wants to understand why. Because deeply embedded in that question is a more uncomfortable one. What does this person know about the next 12 months that the rest of us are still figuring out? And here's the honest answer: we don't know. We can analyze the fee structure, we can check the destination address tags, we can track the subsequent hops, we can model the OTC probability, we can contextualize the timing against the legislative calendar, but we cannot know with certainty whether this specific person is selling, repositioning, migrating custody, gifting to a trust, or doing something else entirely. What we can know is the context: the Senate vote in 72 hours, the reserve announcement imminent, the supply absorption dynamics tightening at a structural level, the liquidity infrastructure now mature enough to handle institutional scale ancient coin exits without visible market impact, the clustering of dormant wallet activity, 859 Bitcoin from multiple generations of wallets activating on a single day, and the on-chain fingerprint of yesterday's specific transaction: low fee, fresh untagged destination, no exchange footprint, OTC consistent structure. None of those individual data points are proof of anything. Together, they describe something: a market in transition. Not a market reacting to events, a market being repositioned ahead of them. There are two ways to respond to what yesterday's transaction represents. The first is to follow the reflex. Ancient whale wakes up, probably selling, be careful. Watch for price impact. If the coins hit an exchange in the next 48 hours, that's confirmation. If they don't, move on. That response is not wrong, it's just short term. The second response is harder and more uncomfortable. To ask not just where these specific 500 coins are going, but what it means that the people who have held Bitcoin the longest are now making moves in the same week that the United States Senate is voting on the most comprehensive digital asset market structure legislation in history. Is that coincidence? Probably. But the people who have held Bitcoin since 2013 have lived through enough market cycles to understand something most investors still haven't fully absorbed. The biggest moves in this asset don't happen when the most people are watching. They happen in the gaps, in the quiet windows, in the days before the headline arrives. The blockchain logged a transaction at block height 948,822 yesterday. 500 coins, $40 million. The motive is officially unknown, but the structure, the timing, and the context all point in the same direction. Something is being prepared for. The question is whether you're paying attention at the right moment, or whether you'll see it clearly only in hindsight. The biggest shifts in financial history never announce themselves clearly in real time. They show up as data points that look like noise until suddenly they resolve into a pattern that everyone says was obvious all along. An 88-fold return held across 12 years and 7 distinct market cycles. A transaction fee of $8, chosen by someone with $40 million to move. A fresh, untagged native SegWit destination address created the day before. An 859 Bitcoin cluster of dormant wallets activating on the same day. A Senate vote in 72 hours. A reserve operational announcement coming within weeks. Taken alone, each of these is just a data point. Together, they describe a specific window of time. A week in May of 2026, when the people who have held the longest are making decisions that the people who arrived the most recently haven't fully registered yet. That's not prediction. That's pattern recognition. If this changed how you're looking at what happened yesterday, hit like. That signal tells me there's an audience that wants deeper on-chain analysis rather than surface-level price coverage. And if you've been watching the wealth continuum long enough that this finally made the full picture click into focus, drop the word Genesis in the comments. These are Genesis-era coins. The word fits. I'll know exactly what you mean. Subscribe and turn notifications on. The Clarity Act vote is in 72 hours. The reserve announcement is coming. And somewhere in a native SegWit address that didn't exist 48 hours ago, 500 Bitcoin from 2013 are waiting for their next move. We'll be tracking it. What topic should we break down next? The wealth continuum. We follow signals before the rest of the world notices them.